There we go. Okay, and so the tools and resources that we have are for people looking to start a business, they're looking to analyze the industry or looking at information for their target market. For those that are existing businesses, we have business lists that we can do. We can also find out what's happening in your industry. We have reports that are updated on a quarterly basis. So we have a lot of resources available to you, again, offered at no charge. Here you'll see a list of some of our services. This is only a small list. And as you look at this slide, I would want you to, I would want you to just think of it this way. If you have a business related question, come to your local SBDC. Let us see if we can help you. This is just a small portion of the services that we can help you out with. The training seminars, you'll see a small list of the training seminars that we here at Clarion and throughout the state offer. There are a lot of webinars, and if you go to our website, which is listed at the bottom, or if you go to www.pasbdc, that's like Pennsylvania SBDC, .edu or .org, I believe, then you will see all of the webinars and seminars that are offered throughout all of Pennsylvania for by all of the SBDCs that are in Pennsylvania. We also have special programs. This particular special program is one that's that really interests me because most small businesses have to deal with environmental regulations. The EMAP program is another service that's offered at no charge. And again, everything is confidential. You'll see there that they help out with air quality, wastewater storage tanks, and they can help you determine what regulations you have to comply with and how to comply with those regulations. And then also if there are any applications that need filled out, a lot of times they can help you out with that and lead you in the right direction. You can reach out directly by going to their website or by calling that phone number that is on your screen. Somebody was asking already if you're able to if I'm going to be sharing these slides with you, and as most webinars, yes, we will be sharing these slides with you afterwards. Another program is our Webnet PA program that we're a partner of. And many of you are employers and many of you have employees. In that case, you may be able to tap into this program by going to the website that you see on the screen there. And you can submit your business to see if you are eligible. And if you're eligible, then you can get up to $2,000 reimbursement money for your employees to train them in the position that they currently hold with you. This training is something that can be provided in your location, or it can be provided by sending your employees out. You get to choose the type of training as well. There's a lot of training that fits into this program. So definitely when you get these slides afterwards, or if you're taking any notes right now, check out Webnet PA, $2,000 per employee if you're eligible for this program. On top of these two programs, going back, being the EMAP program and the Webnet PA program, there's also through the SBDC, there's other special programs such as agriculture, international trade, government contracting, and if you have a product that you're inventing and you want assistance getting it to the market, a brand new type of product, we have special programs for those as well. Again, the cool thing is it's all offered at no charge to you. So look at this state of Pennsylvania and see the different boundary lines. And on the left-hand side, there's numbers on the state, and on the right-hand side is a list of small business development centers. So no matter where you're located across the state of Pennsylvania, there is an SBDC that can help you. And should there be anyone from any of the bordering states, well, there are SBDCs across the entire country, no matter where you go. So if you even choose at some point to move, or you have a family member that lives in another state, please let them know that there's an SBDC that they can reach out to at any point in time. So before we get started and we go any further into this training, I'd like to introduce to you Angel, who is from the Small Business Administration down at the Pittsburgh District Office. And I'd like to turn it over to Angel for just a moment so that she can welcome you all.
Thank you so much, Corey, and thank you for having me here today. I do want to welcome you to the Understanding the Numbers series. very briefly, I joined the SBA about 5 years ago, but I spent my career 35 years in banking, doing commercial lending for small businesses like yourself. And so this is such an important webinar, important to understand accrual accounting versus cash accounting. It's something that, you know, whenever you go to get your loan or you need a line of credit, that, you know, the bankers are going to be looking at. So such a wonderful program, and excited that today is the day that the SBA recognizes our small business development centers across the United States. So it is National SBDC Day, and we are excited to be here with Clarion, with Penn West Clarion, new name, but they do so much to help our small businesses in Western Pennsylvania realize the dream of business ownership. But they also help you get from not only entrepreneurship and the idea to understanding the numbers and forming that business. They help you grow and expand. Like Corey said, you know, when you're ready to export, they can help you with that. And maybe one day when you're ready to sell your business, they can help you with that as well. You know, Penn West Clarion is led by Cindy Nellis, who just has an incredible team like Corey, and they are there to help you through the life cycle of your business. So on behalf of us at the Pittsburgh District Office, we are just here to say thank you to them for doing the invaluable work that they do for all of our small businesses, but want to thank you for working in your business. You know, oftentimes, and like Corey said, you know, he knows business ownership. I've been married to a serial entrepreneur for 38 years. We've started and grown a lot of businesses, and it's hard to take time to work on your business and work in your business, to step away from the business to make sure you're doing it right. And so please take advantage. If it's an hour or two a day, if you can come back and listen to this, of all the valuable resources that they have for you to work on your business while you're working in your business. So Cindy, Corey, you know, we want to wish you continued success. Happy SBDC Day. And thank you for allowing me to welcome everyone to this amazing training that I know you're going to have.
Great. Thank you, Angel. I really appreciate it. And once again, to everybody that's here, happy SBDC Day. This is an opportunity for all the SBDCs across the country to celebrate our small businesses and our entrepreneurs that are looking to open a small business. Without you, we wouldn't be here, and we love what we do. And so something like I said, I've been here for quite a while. I absolutely love what I do. I love having the opportunity to help people. So again, happy SBDC Day. So let's get into this training now. There are a lot of people here. It looks like around 78 people in this room. So we have a big room. I have a lot of exciting information to talk about. I know some of you think that accounting can be boring. I like to think that accounting is fun. So I will try to make this webinar as good as I can, that you won't be falling asleep with me. What we're going to talk about is cash accounting versus accrual accounting and what is involved in it. And at first, as we go through these first several slides, you might start to glaze over, especially if you're new to this, and you might be like, I'm not sure what he's talking about. But what you're going to find is that as we go through these slides here, we're going to start looking at examples. And then that's when the things are going to start to sink in. And I'm going to make you think before I give you the answer. And I'm going to ask you to answer the question as well if you have a microphone. And so what we're talking about is really going to sink in. And I think that by the end of today, you'll have a much better understanding of accounting than what you had when you came here, at least, especially for those that are new. For those of you that are experienced, you know, I still attend accounting classes and different types of classes, even though I have experience in a wide array of running a business. But it's always good to attend these trainings because there's normally something that I need to be refreshed on, or something that I've written down in the back of my brain and I haven't thought about it for a while. So this will be educational, I do believe, for everybody. So the purpose of this particular section of this webinar, session 1 and session 2, this is session 1 that we're in. We're going to talk about the double entry framework. We're going to look at each type of accounting, the cash basis versus the accrual. We're going to outline the differences between the two. And then something that's really important that we're going to deal with under these two types of accounting is accounts receivables and accounts payables. Sometimes we think we're cash, but we also use accounts receivable. We think we're cash based, but sometimes we use accounts payable. So receivables and payables, we'll look at both of them. As I mentioned, we're going to do the hands-on exercises. And then at the end, we're going to summarize the advantages and disadvantages of each. There's also what I call a Frankenstein type of accounting, which we will look at as well. And hopefully we'll have time at the end to go through the little quiz or the test that I sent you via email if you all received that. So the first thing I want to look at right now is this idea of double entry framework. Think of it as when you record a transaction, either on paper, in your spreadsheet, or in your bookkeeping system, there is a way of entry that happens in that bookkeeping system in the background that you really don't know about. But it's really good to understand it, because the time comes when you have to try to analyze, such as we will do in session 2, how your income affects your balance sheet and how your expenses affect your balance sheet. We look at this through the accounting background, and right now we're going to look at the T accounts. So with a T account, there are two different T's that you see here. One has an account name at the top. One says rent expense, the other says cash. Then you'll notice that on the left-hand side, there are it's a debit on the left-hand side of the T. And on the right-hand side of the T is your credit. So left side means debit, right side means credit. With every transaction that you have happen in your bookkeeping system or in your spreadsheet, there's always at least two different accounts that are affected. And therefore you would have two different T accounts that would be affected. So now, on the left-hand side, it may be a debit, it may increase on the left-hand side, and then it may decrease on the right-hand side. But then in another account, it may increase on the right and decrease on the left. So it really depends on the type of account. Let me give you an example, kind of a prelude as to what we're going to get into. Assets debit or increase on the left-hand side. That's always a debit. Those assets, then if you want to decrease it, they decrease on the right-hand side. With the T accounts, the two transactions must always equal each other. So if you put something on the left-hand side, it has to equal that something on the right-hand side then. So if I am doing a transaction where I am paying my rent, what we'll learn here in the future, just kind of go with me here, is we're going to debit rent expense, which will be an increase, and we're going to credit cash, which will be a decrease. So what you see is that the left must equal the right-hand side. And this is what I was talking about here, these different type of accounts, which for you, if you're a real beginner at accounting, then you may look at the idea of what is an asset, what is a liability, what's owner's equity, and so forth. So an asset is something that you own. It's something that's physical in nature. Now, it could also be non-physical in nature, such as a liquor license. It's worth something, but it's not something you can literally, get a hold of. So assets such as cash, accounts receivables, supplies, and then your fixed assets like buildings and furniture and fixtures and equipment. Those are all types of assets. When we look at the T account, they're going to increase on the left-hand side or the debit side, and they're going to decrease on the right-hand side or the credit side. Our liabilities are our debts, the things that we owe. We have current liabilities and we have long-term liabilities. Current liabilities are liabilities that's expected to be paid off, if you want to say, within 12 months. Long-term liabilities are those liabilities that go beyond 12 months. Our owner's equity, that's what our business is worth. That's like our capital that we put into the business. And then as our business is showing profits at the end of the year, that the profits go into our owner's equity. So that's what we're worth. As you see here on the slide, if you want to increase owner's equity, then you're going to increase it on the right-hand side. You'll decrease it on the left-hand side. So something that you may have heard of at some point is called the accounting equation. The accounting equation is our assets equal our liabilities plus our owner's equity. Assets equals liabilities plus owner's equity. So if we think about it, our assets increase on the left-hand side, and our liabilities and our owner's equity increases on the right-hand side. They have to equal each other. And we're going to look at a balance sheet here in just a moment. Then we get down to our income and our expenses, which show up on a statement called our income statement, or a profit and loss statement if you're a QuickBooks user. And we'll be looking at that particular statement in more detail in session 2 next week. But look on the slide here, our income increases on the right-hand side of a T account, and it decreases on the opposite side, or the left-hand side. The expenses, they're going to be completely opposite from income. So they're going to increase on the left, decrease on the right. So if you think about an income statement, or if you think about your tax return for your small business, you have income that's at the top, and then we subtract away our expenses. Okay. And the income is going to be on one side of the T account. And then because those expenses subtract away from the income, they're on the left-hand side of the T accounts. So here's a balance sheet. And if you kind of look, I made a T out of this balance sheet because a balance sheet is kind of like that great big T account. And I had mentioned about the assets being on the left, the liabilities and the shareholders' equity or owner's equity is on the right-hand side. Now, what you'll see here is that the total assets says $336,520. The total liabilities and equity on the right-hand side is a different amount. That can't be. There's a mistake here, because in a balance sheet, the left-hand side must equal the right-hand side. The total assets must equal the liabilities plus the owner's equity. They must equal each other. So what we would have to do as an accountant and as a business owner, as a bookkeeper, whatever your title may be, you would need to figure out why these do not equal each other. The balance sheet, again, we'll look at that in more detail in session 2. So let's dive into accrual accounting. And as we get into and we start looking at the examples, that's when we're going to start seeing more of these T accounts. But for right now, let's get a good understanding of what accrual accounting is versus what cash accounting is. Accrual-based accounting is revenue that is recognized when it's earned, not necessarily when you receive cash. So if I'm going to mow your yard, I'm not sure where you're from right now, but there's snow on the ground, so I don't think we're going to be mowing. But if I were to mow your yard, and after I'm done mowing your yard, you're not home. So I'm going to take a piece of paper, I'm going to put it in your door. That's going to have it's like an invoice that's going to say you owe me $50 for mowing your yard. Under accrual-based accounting, I earned that income when I mowed your yard. Therefore, I will claim it as income at that time. Now, you're going to pay me maybe 15 days later. When you pay me with a cash or check, that's just a flow of cash to me, coming from them to me. I'm going to deposit into my checking account, but I'm not going to count that cash as income because I've already counted the income when I performed the job, which was mowing your yard. So it's when a product is sold or a service is sold, but no cash is necessarily received, that's when I'm going to recognize my revenue. Now, as for my expenses, when will I recognize my expenses? I'm going to recognize my expenses when I consume them. Now, all of you see here this picture of toilet paper, and it might make you think of something that we recently experienced, but that's not the idea of this. The idea is that sometimes we are bulk shoppers. We may go to a place like Sam's Club and buy things in bulk that's going to last us for a long period of time. So under accrual-based accounting, when we purchase something, even though we may not pay cash for it at that time, when we purchase it, that's when we incur that expense. And therefore, that's when we recognize it as an expense. Think of it this way. When I buy or when I use electric, I get an electric bill in the mail. When I get that electric bill in the mail, I don't necessarily have to pay it until like 15 days from today. Under accrual-based accounting, when I receive that bill, I'm going to put that into my bookkeeping as an expense at that time. I haven't paid for it yet, but I've incurred that expense. I've accrued, electricity throughout the month. So that expense is there. I'm going to count it as an expense right now, and then I'll pay it later on. And when I pay it, I'm not double counting the expense. It's just a flow of money from my account to their account. So in this example here, we purchased 5 years worth of toilet paper. The toilet paper becomes an asset in this case called supplies. And as we use that toilet paper, we might make like a yearly end of year journal entry to move some numbers, I don't want to say money because we've probably already paid for it, but to move some numbers from a supplies asset account to maybe an expense account called operating expenses. And we're going to look at an example like that as we go through today. And so again, that's when you, because even though you didn't pay cash for it, you get to consider it as an expense. If we think about it at the end of the year, December into January, if you buy something in December and you're under accrual-based accounting, you can count it as an expense in December. Although you won't pay it until January, you'll still have the cash in December because you're not paying it until January. That can have an effect on your taxes, right? Small business owners will go to their accountants and at the end of the year and say, hey, can you run some numbers for me to see if I need to spend some money before the end of the year? Under accrual-based accounting, you may not necessarily be spending money as in, actually outlaying that cash, but you would be making purchases before the end of the year so that you can count those as expenses. That's what accrual-based accounting allows you to do. So under accrual-based accounting, when we are considering those items as expenses, and then again, we're recognizing revenue when we earn it, not necessarily when we receive the money, it helps us do a better matching of our numbers. We can match our expenses that we are incurring with the expenses, with the revenues that we're earning. The costs that are associated with producing revenue, such as rent expense, for January against January revenues, even if the rent was paid in December. So those two items are going to get matched together. And when you are analyzing your income statement and your balance sheets, they're going to have a better connection. The accrual-based accounting is required to use GAAP if you are a publicly traded company. So I know probably most of you are not publicly traded companies, so you're not going to have to comply with generally accepted accounting principles. However, if I think about it from an accounting standpoint, the generally accepted accounting principles are what's out there that we're not required to follow if we're not publicly traded, but they still have a trickle-down effect, and we are still complying with those things. That's how we're operating our business, whether you really know it or not. It's the way we recognize our income and the way we recognize our expenses. But if you are publicly traded, then you would be complying with GAAP. So there's this thing called the revenue recognition principle. And we've already talked about this, but I want to give you that better understanding. It dictates that revenue be recognized in the accounting period in which it is earned. Again, you think about it at the end of the year, that's probably the easiest way to recognize or to get an understanding of it, because your tax return most likely goes from January through December. And so if you're earning revenue in December, that's when you get to claim it. versus you may not receive the cash until January or February, but you at least get to earn that revenue in December. In a service business, revenue is considered to be earned when the service is performed. Again, when I was mowing your yard. On the expense side, I talked to you about the matching of expenses versus revenue. So the matching principle is going to dictate that your efforts, your expenses that you incur will be matched with the accomplishments or the revenues of your business. Versus under cash-based accounting, which we haven't quite talked about yet. Cash-based accounting is just going to deal with cash in, cash out. It's not really looking at when you earned your revenue and when you earned your expenses. So under cash-based accounting, it's all about the cash. Revenues are going to be recorded when cash is received. So if I mow your yard today, I am not going to recognize that as income until I am paid. So if you don't pay me for 2 months, then it'll be 2 months from now that I'm going to claim this as income. At the end of the year, I mow your yard, but it's January when you pay me. So it's January when I'm going to claim that as income. Now, there can be benefits to that, and I'm going to show you a comparison between accrual accounting and cash accounting here in a moment to see how the numbers are actually affected. So some days you may say, yes, I would rather claim the income in January versus in December. So we'll take a look at that here in a moment. On the expenses side, the expenses are only going to be claimed when the cash is paid. So if you buy supplies today, but you don't pay cash for it until next month, you will not claim that as an expense until next month when you actually pay that cash. Now, most of the time under cash-based accounting, you're going to buy the supplies right now and pay the cash right now. But remember, cash-based accounting always goes by when you receive the cash or when you pay out the cash, one or the other. So since this method records revenues only when cash is received, there will be no accounts receivables. So let's pause and go back to accrual-based accounting. Under accrual-based accounting, when I mowed your yard and I put that invoice in your door, that created an accounts receivable, meaning that I am going to receive money at a later point in time. Cash-based doesn't have that. Cash is just cash. When you receive the cash, that's when you have it. That's when you have income. Also, since this method records expenses only when cash is paid, there's no accounts payable. Again, let's go back to accrual-based accounting. So you have a utility bill that you received, and you can enter that in as an expense right now, although you're not going to pay it for a month. So that's accounts payable, something that needs to be paid later on. Versus cash-based accounting, it's claimed only when the cash is paid. So there's no accounts payables in your bookkeeping system whatsoever. Also under cash-based accounting, all cash spent is recorded as an expense. Therefore, there are no long-term assets and no prepaid assets. Now, that may sound weird to you because you're thinking, like, especially from a tax standpoint, that when you purchase a piece of equipment, your accountant wants to know how much did you spend on that piece of equipment so that they can depreciate it. Well, under cash-based accounting, purely cash-based accounting, there are no long-term assets. When you buy a piece of equipment valued at $100,000, you would write that off 100% when you pay out that cash. Also, there's a thing called prepaid assets. Prepaid assets is like paying your rent ahead of time. Maybe you have enough money in your checking account to pay for rent for the next 12 months. And so that creates a prepaid asset called prepaid rent. Also, if you have insurance that you pay once a year and you want to pay it for the entire year, that would create prepaid insurance. And we'll dive into that a little deeper as we go through this webinar as well. But again, cash-based accounting doesn't have any type of long-term assets. So let's take a look at some transactions now and see how they're recorded under both accrual versus cash-based accounting. So the first transaction is providing services on account for $600. So we provided services, we're not getting paid yet. So can anyone tell me, anyone want to speak up now and tell me, is this a revenue or is this an expense under accrual-based accounting? Oh, everyone's being quiet. I hope to get you talking here momentarily. I got some people smiling though, so that's good. So it is going to be revenue under accrual-based accounting because we did perform a service. Even though we didn't get paid any money, we performed a service, so it is revenue. Under cash-based accounting, whoops, I forget, I always have these little red balloons here that pop up. Under cash-based accounting, though, there is not going to be any transaction to be recorded because we did not receive any money yet. No money changed hands, therefore there's no revenue to be recognized. Now that you see what's happening, let's see if you can answer the next one. So we paid wages, somebody worked for us today, and we paid wages to them today for $300. This is an expense for our business. Will we recognize it under accrual-based accounting? I have some heads going up. I have some heads going no. We are going to recognize it. Now, yes, there was cash involved, but we also incurred the expense, right? We realized an expense of $300. So we can ignore that cash was ever involved in this when we're dealing with accrual-based, because accrual-based is going to go by whether we earned income or whether we accrued the expense or incurred the expense. So under cash-based accounting, there is going to be an expense as well because cash did move. So since cash moved from my pocket to someone else's pocket for wages that they earned, that will be an expense for my business. Another example, we received cash for services performed on account last month. We received money for services that were performed last month, and it was $200. So that sounds like since we're receiving something, that must be income. Okay, so do we recognize this under accrual-based accounting? I see some heads moving here. Okay, so we are not going to recognize anything in this example, and the reason for it is under accrual-based accounting, it says we received cash for services performed on account last month. So it was last month that we would have claimed it as income. Therefore, when we receive money now, it's just a cash flow from one place to the other place. What about under cash-based accounting? Will we recognize it as income? I see some heads shaking there. So we are going to recognize it as revenue because we are receiving the income now. So again, think about it in my mowing example. I mowed for you last month. And under cash-based accounting, though, I'm not going to recognize it as revenue until you pay me. So since you're now paying me today, I get to recognize it as revenue today. Next example, we received a cleaning bill for the month for $250. So this sounds like it's going to be an expense, okay, because I see the word bill. So I received a cleaning bill today for $250. Will this be recognized as an expense under accrual-based accounting? I see yeses going up and down here. and it will be because we incurred that expense. We incurred the expense for the cleaning. What about under cash-based accounting? Okay, I see some heads shaken, and you are correct. There will be no transaction involved in this, or nothing to record under this transaction because no cash was involved. Cash-based accounting, as we go down through a couple more of these here, cash-based accounting, just keep telling yourself, was there cash flow? Was there cash flow? If there's no cash flow, then it doesn't affect cash-based accounting. Next example, we paid money on account for last month's advertising of $100. So we actually paid some money under accrual-based accounting. Will we write off this $100 as an expense? I see some heads shaking no. And that is correct, because we would have recognized that expense last month when we agreed to the advertising. What about under cash-based accounting? Will we recognize it? Okay, now we're all getting a hang of this now. Cash was involved, so it is an expense under cash-based accounting. Good job. I'm going to assume that everyone that doesn't have their cameras turned on, many of them don't have cameras, but they're getting all of these 100% correct. So we're going to be good here. Okay, we purchased supplies for $50. We purchased supplies today for $50. Is this an expense under accrual-based accounting? I have head shaken on this. So I'm going to say no, because we're going to list it as an asset. Now, I know you're thinking of operating supplies being an expense. But when we're looking at buying supplies, a balance sheet normally has an asset called supplies. Now, something as we're talking about these supplies that we're buying ahead of time, if you think back to that toilet paper picture, the reason I had picked that picture, and I forgot to tell you all, was when my wife and I bought our house almost 18 years ago, we bought like a lot of the stuff that was in the house as well, because it was an old couple that was moving out into a smaller place. They had enough toilet paper in that house that lasted our family for almost 4 years. Okay, so there are people that buy a lot of things ahead of time, and you might have been one of them during the last few years when we dealt with COVID. You very well may have been one of those people that bought a lot of toilet paper. What about under cash-based accounting? When we purchase these supplies of $50, will we recognize it as an expense? Okay, I see some heads shaking, and yes, we are going to record it because cash moved. And again, cash-based accounting is not going to have any type of long-term asset. And so supplies, if we're buying enough supplies like toilet paper to last us for multiple years, even though supplies is considered a current asset, we still have enough inventory, enough supplies, I should say, to last us for a long period of time. So cash-based accounting does not have any type of long-term asset. Okay, supplies used during the month of $40. So these are those same supplies that we just purchased for $50. Now we've used $40 of it in a month. Do we recognize it as an expense under accrual-based accounting? Oh, there I see some chats going through from the people that don't have cameras. Good, good. Okay, so we are going to recognize it as an expense because what we're doing under the previous example, we created an asset called supplies, and that's where the $50 went. Now that we're using $40 of it, we are moving $50 or $40 out of this 50 and moving it over to an operating expense. So if I were to record a couple T accounts, I do believe you'll be able to see what I'm going to write on my screen here. So I'm going to draw a couple T accounts. So I purchased supplies for $50. So I'm going to create supplies. Can you all see this on your screen? Yep. Okay, good, good. And supplies is an asset account. So if you recall from some slides earlier, an asset gets increased on the left-hand side. So $50 on the left-hand side. As I mentioned with a T account, everything has to have something on the opposite side. So that's where the other T account comes into play. And we paid $50. So let's say we used cash or a check. Okay, we are going to use cash and $50 on the right-hand side. So the left-hand side must equal the right-hand side. Now, just to throw a little extra out there, you can have more than two T accounts if there are more than two accounts involved in a transaction, but this particular transaction, there's only two of them. Now, when we look at this last example of the supplies being used during the month of $40, we're going to have another set of T accounts, and we're going to have supplies again. Again, this is an asset. That's why I kept it there on the left-hand side. And then we're going to have maybe a supplies expense, but we'll call it operating supplies. And this is an expense. So we need to decrease our asset here by $40. And the way we do that is by putting 40 on the right-hand side. So an asset is increased on the left and decreased on the right. So by putting the $40 on the right, that is decreasing the supplies asset. Then our expenses are increased on the left-hand side of our T account. So we're going to put $40 right here. And these are always in balance. Left and right always has to be in balance with each other. So if we take a look at the cash-based accounting, what's going to happen with cash-based accounting? Supplies used during the month of $40. Will there be a transaction? I see some heads shaking. I see some chats coming through. And again, there will not be any transaction because we already paid for it in the previous example when we purchased the supplies of $50. Good job, everybody. Now that was just a little bit. We're going to have a lot more questions coming up here, okay? But I have someone like, oh no, but it's great because by going through these examples, I can see that you're catching on to what we're talking about here. So the next thing we're going to look at with accrual-based versus cash-based is how they add up to each other when it comes to the numbers. So if we add up all of our expenses, it results in a total of $590. Our revenue was $600. So if we take our $600 minus $590, we're going to be left with a profit of $10. A profit of $10 under accrual-based accounting. Under cash-based accounting, you'll see that our expenses added up to $450. Our revenue added up to $200. And it's showing us that we have a loss of $250. So there can be some major differences between accrual-based and cash-based. And every one of these transactions, as you see going across here, they relate to each other, okay? So under cash-based accounting, you may very well show more of a loss in your business than you would under accrual-based accounting. And if you think about it at the end of the year, December and January, again, I threw out this idea that you go to your accountant and you say to your accountant, hey, can you run some numbers for me to see if I need to spend some money at the end of the year? Under cash-based accounting, you are literally looking at spending money. Because under cash-based accounting, you have to have an outflow of cash from your business in order to be considered an expense. Accrual-based accounting, if you happen to receive revenue at just the wrong time or right time, maybe, will depend on whether you're going to have to claim it in December or January. I've heard of people that will receive a check from one of their customers under cash-based accounting, receive one of their checks on December 27th. And they're like, oh no, now I got to claim it as income because I received the money in December. I won't tell you what to do, but you could possibly make that flow over into January if you wanted to. Now we're going to talk about the Frankenstein. The Frankenstein is the modified cash basis of accounting. I call it the Frankenstein. That's my own little take on it, mostly because it's a combination of cash-based accounting and accrual-based accounting. And it flows pretty well with tax-based accounting as well. There's all these different bases of accounting. So the way you do things on your taxes, a lot of times look like modified cash basis, especially if you are cash-based accounting. So some of you might be like, I don't know if I'm cash-based or accrual-based. Probably the first place to start is with your accountant. Ask your accountant whether you're cash-based or accrual-based. He or she should be able to answer that, really quickly for you. But if you think to yourself, when do I normally recognize the income and when do I normally recognize the expense? If you're doing it based on cash, then you probably are cash based. So if you are cash based, almost all of you are probably operating under Frankenstein, the modified cash based of accounting. So at the bottom of the slide here, you're going to see that your revenue and your expenses correlate with cash-based accounting. So your revenue, you'll only recognize it when you receive cash. Your expenses, you'll only recognize those expenses when you pay out money, whether it's be cash, check, credit card, money order, doesn't matter. When you finally pay something out, that's when it's considered an expense for your business. Now there's an exception when it comes to assets. If you have an asset that has a useful life of more than 12 months, then you will have what we call fixed assets in your business under modified cash based. Remember, under cash based, you had no assets. Under accrual based, you will have assets. Under modified cash, this is where you get that mixture because you are going to have assets. And you see here, I gave you the examples of prepaid insurance, supplies, equipment, and building. So under modified cash basis, you will have those prepaid assets, prepaid rent, prepaid insurance, and also like supplies, as we looked at in the examples earlier, where you buy enough supplies to last for a long period of time. Also under modified cash basis, you're going to have those long-term assets that's going to last for more than 12 months. And because we're going to have long-term assets, you're also going to have accounts payable, but only for long-term assets. So if you have a utility bill that you receive in the mail and you're going to pay it 15 days later, under accrual based, you recognize it as an expense because you'll pay it later. This is basically what modified cash is following, but only for those long-term assets, not for the utility bill. The utility bill will still be based on cash basis, which is when you actually pay your cash. So it gets a little difficult here, but the way I want you to think about it is revenue and expenses are cash-based accounting, and then your fixed assets and any loan payments that you have for those fixed assets will follow accrual based. That's what your modified is. You're bringing a little bit from one side and a little bit from the other side. There will still be no accounts receivables because I told you that revenue, you only recognize it when you receive the money, so that there's no accounts receivable whatsoever in modified cash basis accounting. So we're going to go through some examples now. I'm running a little ahead of schedule, I think, here, but we should be good. I want you to answer these questions. So for those of you with your cameras on, I'll watch for your head shaking. Those of you that don't have cameras, please continue answering in the chat with your yeses and nos. So this example here is performing services for cash. We're performing services for cash. Now, I'm going to go through this first example because I want to talk to you about another way of utilizing T accounts. So we were looking at T accounts like this here, with something on the left-hand side and something on the right-hand side. There's another way of looking at it though. And so in this example here that we performed services for cash, we're going to see that we are bringing cash into our business. That's the one account that's going to be affected. And then we're recognizing revenue, which in this case is called professional fees. And so on top of these T accounts, I would have cash debited on the left-hand side because it's on the left-hand side down here. And the credit on the right-hand side is going to be our, whoops, I wrote up too high here. It's going to be our revenue. Sorry, I have Zoom in the way, so I grabbed my Zoom. So you'll have revenue with $50 on the right-hand side. Now, we're not looking at dollar amounts in these examples, but if I were to write them, hold on, let me get my pen to work again here, then it would be 50 on the left, 50 on the right, is the way we would be writing this. Now, under modified cash-based accounting, we are going to recognize it as well because revenue, which is what this is here, revenue follows cash-based accounting when we're dealing with modified cash. Then when we're taking a look at accrual-based accounting here, we're also going to recognize it because we earned the income. Forget about the cash. Remember, accrual-based accounting doesn't worry about cash, if you want to say. So it's when we earned it. And if we perform services today, we get to claim it as income in our business. So all of these examples are going to deal with these indentations. On the left-hand side will be the debit. On the right-hand side will be the credit. So let's look at another example. I apologize, I'll get used to bringing up these red bubbles for you here. The next example is performing services on account. Performing services on account. So 2 T accounts, except one's going to be on the left-hand side, one's going to be on the right-hand side. Will we recognize this under cash-based accounting? We performed services, but we did not receive any money. I have some head shaking, and there is not going to be any entry because no cash exchanged hands here. What about modified cash basis? Okay, I see letters coming up. I see people shaking their heads. And again, there will not be any transactions because modified cash basis, when it comes to revenue, which is what we did here, perform services, when it comes to revenue or expenses, modified follows the cash-based system of accounting. Okay, what about accrual-based accounting? Will we recognize revenue here? Yes. Now the question would be, what are we going to recognize? Got to get through these red bubbles here. We are going to recognize accounts receivables. And I see some head shaking that they agree with that, okay? So we recognize the revenue, and in our T accounts, we would have revenue and accounts receivable. Revenue gets credited. Anything that's revenue always increases on the right-hand side. So revenue gets increased. And then the accounts receivable gets increased. Accounts receivable is an asset. Revenue is the income. So someone's asking, where do you put income for prepayment for services not performed? So like a down payment. So while we're here, because I don't think this is one of the examples that we talk about. So how do we record this as a down payment? So let me put some thought into this here. What are we going to debit is always what I'm asking. What are we going to debit? What are we going to credit? If we get a down payment, we're going to debit cash for $50. And then let me think here, because we received the money, it has to go into our checking account. And then on the right-hand side, we're going to credit, where do you put income for prepayment? It's a down payment. I think it's a, oh man, I think it's a liability account. What's it called though? Because it's a credit to their account.
Corey, I think it would just be a prepayment, right? Or unearned revenue.
Oh, there you go. Unearned revenue. Yes, yes. Unearned revenue. Boy, I haven't dealt with that one in a while. There we go. Thank you. Well, I think that was Cindy that jumped in. I appreciate that. Catch me off guard on some of these questions, but I want to try to answer them for you. So it's a debit to cash because there's money going into your business. And then you have the unearned revenue of $50. And that would be a credit. So then I got to think of whenever we perform the service, what do we debit and credit? I'll have to think about that one. I apologize. You got get me off guard there. I got to think about how we record these different transactions here, because at some point we need to turn it into actual revenue, right? So I'll have to put some thought into that one. Good question. Okay, so another example, we're paying cash for operating expenses. We are paying cash for operating expenses. So think of those T accounts again. But again, it's listed this way to where we're going to have one on the left-hand side, one on the right-hand side. Will we recognize anything under cash-based accounting if we're paying cash for operating expenses? I see people answering saying, yes, we're going to. Good, good. So what we will see here is that an expense will be on the left-hand side. That'll be our expense. And on the right-hand side will be our cash. And that's why we have it on the left here and indented, and on the right, right there. So we're dealing with an expense. How do we, or do we even report it under modified cash-based accounting? Will we report it under modified cash? I see people answering in this case here. And that is correct because revenue or an expense was involved, and revenue and expenses always go along with cash-based accounting. What about accrual-based accounting? Will we recognize it under accrual-based accounting if we're paying cash for operating expenses? I see people thinking, a couple heads shaking. Okay, I'm getting some answers to come through now on our chat here. So we are going to recognize it. It's going to be the same thing, not so much because cash was involved, but because we incurred the expense. Since we incurred the expense today, we get to recognize it as an expense today. We pay cash for prepaid items. Now, this is where we're dealing with prepaid rent and prepaid insurance and enough supplies that it's going to last us for a long time. So under cash-based accounting, will we record this as an expense or as an asset or as anything? I see heads going up and down. I see some people saying no, and we are going to recognize it because under cash-based accounting, there are no expenses, or don't mess you up there. Under cash-based accounting, there are no assets, no long-term assets. No long-term assets under cash-based accounting. Therefore, we're going to recognize it right now when we buy it. What about under modified cash-based accounting? What do you think? I have people saying, yeah, we're going to make a transaction here. And in this case, we are, but it's going to be different because since we're dealing with assets and long-term assets, modified cash basis now looks like accrual basis accounting. So I've given you the answer already to accrual-based accounting in that it will be recognized under accrual-based accounting. So then, let me see something here. Bring up my bubble here. Let me see what my next example. Okay, let me go back here. Okay, let me talk about this a moment. So we're debiting the asset, prepaid asset for $50. We're crediting cash for $50. Now let's talk our way through this again. When we go to use some of this, some of these supplies, whether it be like supplies that are lasting a long period of time, or whether it be your insurance, or whether it be your prepaid rent. I once had a client that came to me and said, I have enough money in my checking account to pay for rent for 12 months. Can I do it? I'm like, absolutely, yes, you can do it. We're going to set it up as prepaid rent. So every month she needs to make a transaction in her bookkeeping system. And what she's going to do is create these two T accounts, and she's going to take money, not so much money, but dollar amounts. Okay, there's really no money being moved at this time every month. It's just we're moving numbers from one place to the other. So she's going to decrease her asset, let's say by $40. That was the supplies that we looked at before, but let's think of this as rent. Okay, she's going to decrease it by a certain dollar amount every month. And then it's going to be an expense that she's going to move it over to, which is like rent expense. And rent expense always gets increased on the left-hand side. So we looked at that example with the supplies, but I just want you to understand that it needs to move. It cannot just stay right here. You do have to make a transaction or a journal entry every month in your bookkeeping system. Okay, so now we are paying cash for property, plant, and equipment. Paying cash for fixed assets. Will there be a transaction under cash-based accounting? I see someone answered via the chat. I don't see anyone answering in video there. So there will be a transaction. What will it be, though, is the question. We're all wondering what that might be. Under cash-based accounting, there are no assets. Therefore, when you buy a piece of equipment, even at $10,000, at $10,000, you will write that off as an expense and then you're paying cash for it. So you might be like, well, Corey, when I do my taxes, they always depreciate that. Why are we not depreciating it here? And it's the way the system is set up. Someone long time ago figured out the way these types of bases would work: cash basis, accrual basis, and modified cash basis. And so under cash basis, there are no assets. But that's why I tell you that most of you, if you're cash based, you operate under modified cash base, because modified cash basis will take into account assets, and you will create an asset for your equipment for $10,000, and it will go on your tax return, and it will be depreciated over a number of months. So accrual basis is also going to follow the same thing as modified cash basis, since it deals with fixed assets. Any questions? Any thoughts as we're going through this? Oh, here we have a question in our chat. What if a loan is used to pay for the equipment? What if a loan is used to pay for the equipment? Okay, so let me draw some T accounts here. I'm going to bring in equipment which is an asset, so I have to increase it on the left-hand side. So let's do it for $10,000. Then I bought it with a loan, and a loan increases on the right-hand side. So that'll be $10,000 left and right. Now the question will be, how do I pay down that loan? And if you recall at the beginning, I told you that we could have more than 2 T accounts involved. So we're going to have 3 T accounts involved here. And let's say that the loan, well, let me think here. We're going to have cash involved, right? And it's going to go down. We're going to have the loan involved, and we're going to have interest involved. So the loan is the principal portion of the loan, right? That's how much you borrowed from the bank. So let's say the payment is $500. $500 is coming out of your checking account. Assets are decreased on the right-hand side. The loan principal portion of this payment that you're making is going to be decreased because it's increased on the right. So we have to decrease it on the left. Let's say that the loan payment was, or the principal was $225. So the value of your $10,000 loan just went down by $225. But with most loans, you have interest involved. You have interest involved, right? So the interest expense, which increases on the left-hand side, is going to be $275. You'll record this transaction each and every month that you make this loan payment. Now, as for how to depreciate the equipment, we're going to look at an example on that here momentarily. So I'm not going to go through that right now, but what I went through already, I don't think is in my examples. That's why I wanted to show this to you while I was answering your question. Again, this $500 loan payment, you'll be making this particular transaction every month. Now, if you looked at it from this standpoint here, okay, you would end up having 1 on the left and 2 on the right. So the one on the, hold on a second here. No, sorry, I did that wrong. You're going to have 2 on the left and 1 on the right. So cash is on the right for 500. And the 2 on the left is going to be your loan principal and your interest for those appropriate dollar amounts there, 225 and 275. That's how that would be written there. Okay. Again, this is good to wrap your mind around. I was just helping a client this morning that was dealing with a loan payment, how to set up the loan, how to set up the asset, and how to make those loan payments. And it takes some thought to put this, to do this, because you don't necessarily set up a loan every day of your life, right? You set up a loan once in a while. So it's not something that you just always remember. So if you always ask yourself, what gets debited, what gets credited, what gets affected is what I've been asking throughout all these examples. What gets affected? If you can figure out what gets affected, then we need to think about what items are debited and what items are credited. So let's look, that was a great question. If you have more questions, please put them out there. Let's look at another example. We received a bill for services received. We received a bill for services that we received. Under cash-based accounting, will there be a transaction? I see heads nodding. I see people typing. I appreciate that. And that is correct. There will be no entry because there will be, there is no cash being moved around. And someone commented saying expense when actually paid. That is absolutely correct. Good job. What about under modified cash basis? What's going to happen there? Will there be a transaction? There'll be no transaction, as people saying. And the reason for that is because there's no cash receipt or no cash involved, and because it was an expense, therefore, revenue and expenses follow cash-based accounting. What about under accrual-based accounting? What's going to happen there? I have people nodding their heads. So what's going to happen is we're going to have an accounts payable. So we received a bill for services received. We get to claim the expense now, but the money's not due until later, hence the word bill. And that's why we create an accounts payable. So I do want to show you this here. We'll do it in the form of, this time rather than the T accounts. Okay. So the question is, if I created an accounts payable, which is a liability of $200, and I'm recognizing the expense of $200. When I go to pay this bill a month from now, how do I record the transaction? So I need to take my accounts payable. I know I need to work with accounts payable because that's what's been increased. So now I need to decrease my accounts payable. If I'm going to decrease my accounts payable, then that's going to show up on the left-hand side for $200. What's going to show up on the right-hand side though? What's going to show up on the right-hand side, I'm kind of waiting for anyone that's chatting to see if they throw anything out there. When I go to actually pay it, there we go. Now we got them coming. It's going to be cash. So there's two T accounts involved here. The top one is a T account on the left-hand side, and the bottom one is a T account on the right-hand side. Good job. Thank you.
So Corey, there's a
Yes.
question in chat that says, just to kind of close this conversation, what if you pay it today? Does it still go into accounts payable?
Okay, let me go back here. So no, if I received a bill for services received and I'm going to pay it today, I would say I would just go ahead and put it right to cash right away. You could, would there be anything wrong with doing accounts expense and accounts payable and then right away turning around and doing accounts payable and cash? You could do that, but it's kind of like extra work. So if you're going to pay it right away, I would just use cash right there. Thank you. Okay, so next up is wages earned by employees but not paid. Wages earned by my employees today, they earned the wages today, but not paid. What's going to happen under cash-based accounting? I see people shaking their heads. What about in the chat? There we go. We got some chats going. There will be no entry because there's no cash involved. You can kind of see, I hope you're getting the hang of this, that under cash-based accounting, it's pretty straightforward. It's cash coming in, cash going out. That's the way most businesses like to operate. I had a client some years ago that I helped them start up many years ago, and they operate under cash-based accounting. And they operate as their business grew. Their business grew to be multi-million dollars in revenue, and they're still operating under cash-based accounting. Now, really, for tax basis purposes, they would have been operating under modified cash basis. That's how really all of us operate again. But they stayed as cash basis until they hit a certain threshold. The IRS actually has a threshold that if your sales reaches a certain amount, then you must go to accrual-based accounting. And there are some other requirements as well that will have you go from cash to accrual, or you may even choose to go from a cash to accrual, such as dealing with inventory. When your business needs to buy inventory, then you're looking at having accounts payables because you are buying inventory on account. You're buying inventory on a line of credit, something like that, that's going to be paid later on. So a lot of times, if you're an inventory-based business, then you want to be accrual-based. But that's not always the case. The best thing to do is to talk to your accountant, let them learn more about you, and they'll be able to answer your question better. So again, I think most of you would want to be a cash-based accounting system, and then there's just certain times when you do need to flip over to accrual-based. Okay, so back to this example, we earned wages. Our employees earned wages, but they weren't paid. So what do we do under modified cash basis accounting? Is there a transaction? I have heads shaken. I have some people saying I'm not sure about that. And there's not going to be any entry involved, okay? Because we're talking about an expense right here and then cash right here. So since we're looking at revenue and expenses are for modified cash basis, act just like cash-based accounting, there's not going to be any entry in this case here. What about accrual-based accounting? What are we going to have a transaction here? We are. Now the question is going to be, what will those debits and credits be? We're going to have an expense and we're going to have a payable, a liability. So wages earned of, say, $250, and then we're going to have a wages payable of $250. And again, if we take this to the next step, when we go to actually pay this at the end of the pay period, every 2 weeks or weekly, something like that, then we're going to take wages payable and we'll debit it for $250, and then we're going to pay out cash for $250. That'll be our end of the pay period transaction that we're going to make. So while I'm here, things that go through my head and trying to relate these to what we're going to talk about in the future, especially getting to session 2 next week, is wages payable is a liability that shows up on the balance sheet. Wages expense shows up on the income statement. So our accrual-based accounting, it helps us see the whole picture of what's going on in our business, because we have a balance sheet involved and we have an income statement involved. Under cash-based accounting, you really just have an income statement, or some of us call it a P&L, profit and loss statement. Under cash-based accounting, you really don't have a balance sheet because you don't have fixed assets and you don't have liabilities under purely cash-based accounting. Now, again, we talk about modified cash-based, that Frankenstein, when we are mixing them, then we can have a balance sheet and an income statement. So in my mind, both of these are the 2 ways that we want to be operating our business. Next item, we have prepaid items used. So we purchased those supplies ahead of time, and now we are using them. Let's see if you remember what we talked about earlier. So under cash-based accounting, will we have a transaction? I have head shaken. I have people answering, and the answer is no, we will not have an entry. And the reason for that is because we would have paid cash for it a while ago. When we first bought those supplies, or when we first paid that insurance, we would have recognized it. What about under modified cash basis? Will we have a transaction? I see people answering. I see people saying, I'm not too sure about it. And so we will, because if you recall, when we purchased these prepaid items, our left and our right was that we had a prepaid asset that we debited, and we credited cash because we paid for it. So now we just got to take the prepaid asset, this right here that we increased, and we need to decrease it on the right-hand side and move some of this dollar amount over to the expense side. Move it from our balance sheet, this is our balance sheet, over to our income statement or P&L. So what about under accrual based? Will we have a transaction under accrual based? Sounds like it, pretty obvious, since that's what we're following right for this example, is accrual based accounting. Good job. But I always forget my little red balloons there. I'll give you a moment to read my red balloon there. And again, you will get this slide, these slides at the afterwards later on today, so that you'll be able to go through each one of these and read these red bubbles that I keep forgetting. I'm speaking them aloud, so I think that you'll get the understanding. Okay, so an end of period adjustment. This is depreciating property, plant, and equipment, depreciating your assets. On your tax return, you have assets all the time that are being depreciated. So what's the transaction that happens behind it? And it happens on your tax return. Your accountant takes care of that. But you then need to go into your bookkeeping system and you need to record the depreciation as well. And so that's what we're going to look at this time. Under cash-based accounting, what will we have a transaction? I have people saying no, there will be no entry. And the reason for that, again, is there's no cash being moved. When we bought the equipment 2 years ago, that's when we paid cash for it. And that's when we recognize the expenses, when we paid the cash. What about under modified cash basis? Okay, people are getting the hang of it. They're starting to answer these questions. That's good. You're answering them correctly, is what I'm saying. So under modified cash basis, we are going to have a transaction, and that is this depreciation expense and accumulated depreciation. So let's back up a moment and let's take a look at these transactions again. So when we purchased the equipment, we used an asset, a fixed asset account for $10,000. We paid, well, let's say we did a loan for $10,000, kind of jumping off that question we had earlier. So then to record depreciation, we have the example that we just looked at on the screen there, depreciation expense being debited, accumulated depreciation being credited. You might be asking yourself, why don't I see an asset account here, like for this equipment? Why don't I see that right here? Okay, what happens is that $10,000 asset retains its value of $10,000 on the balance sheet. It never changes until you sell it or throw it away. As long as it's on your balance sheet, it'll always have a value of $10,000. But what happens is you need to offset it, because that's the depreciation. You need to offset it, and that's accumulated depreciation. Accumulated depreciation is called a contra account. It goes against another account. And then depreciation expense is what allows you to deduct it from your income. So the expense, we like it because it subtracts away from our income. Now, the contra account, I do want to talk about this for a moment. So the contra account, when we're looking at our balance sheet, you're going to have your equipment listed there for $10,000. And then underneath it, you're going to have your accumulated depreciation. And it's going to be a negative number. And it's not going to be 10,000 because this piece of equipment is going to be depreciated out over like 7 years. And so let's say that the yearly depreciation amount is let's say it's $2,100. So in parentheses here, as a negative, it will be $2,100. That's how this is going to show up on your balance sheet. What's the balance sheet we look at in more detail next week on Wednesday. But I want to give you some introduction to it at this time. Now, when you go to sell this equipment, the value now is, and can somebody add up 10,000 minus 2,100? I don't have this on this computer here. I'm not that quick of an add. Who can give that to me in chat? 7,900, thank you. Don't ask my brain to work that fast when I'm trying to teach. So 7,900, or someone saying 8,900, 89.99. Yeah, I'll go with $7,900. So when you, this is the cost value now, $7,900. When you go to sell it, if you happen to sell it for $9,900 because maybe it's worth more than what after your depreciation, you're actually going to have a capital gain on your tax return. The difference between 9,900 and 7,900 will be your capital gain. You'll see these things on your tax return. I'm not sure if your accountant explains these things to you. Now you'll have a little better understanding of what's happening if your accountant goes down through and starts showing you line items on your tax return. And if you have further questions about this, because I'm opening up a can of worms right now when I start introducing these things, feel free to ask the questions of us. And if you don't ask it today, this is my plug for all the SBDCs. Reach out to your local SBDC and talk to your business consultant, and they'll be able to answer these questions for you as well. Okay.
Hey, Corey. Hey,
Yes.
Corey. So there was a question by Kathy in the chat, and I thought before you moved on, you might want to address it. If you pay your insurance in January for the year, can you expense each month ahead of time?
Okay. If you pay your, okay, right there. If you pay your insurance in January for the year, can you expense each month ahead of time? So, so if you pay your insurance in January for, can you expense each month ahead of time? For the entire year, let's say. You pay your insurance for the entire year in January. Normally that would create a prepaid asset, at least under accrual based or under modified based. And I had showed you how to make a monthly transaction to be able to take away from that asset and turn it into an expense. But I think you're asking yourself, asking me, maybe if under accrual based or under modified cash based, do I really have to create the prepaid insurance and make this monthly transaction, or can I expense each month ahead of time? Can I just do it all at one time? And in the case of something like insurance, the black and white is follow the rules that I gave you, but the IRS would say, okay, if I paid insurance of $1,000 a month, so $12,000 a year, all in January, do I need to make that monthly transaction? I would say no, you don't, as long as you wait until January of the next year to pay your next year's insurance. Let's say it's $13,000 now, everything goes up in price, right? So this is going to take care of a whole 12-month period. And so if you only write it off in January, the IRS shouldn't have a problem with that. Now, there's a lot of caveats that can go into play here, because if you shut your business down mid-year, or if you sell your business mid-year, you're going to have some sort of adjustment mid-year because you did write it all off at one time right there. But assuming that you're going to be in business and you're going to operate for the next 10 years, hopefully, for a long period of time, the IRS will not have a problem if you write it all off in January for that entire year. Hopefully, Kathy, that answered your question. Let me scroll back down here now. Okay, okay, so here's a question. Do you have to remember to expense it each month, or or can you do each month ahead of time? Oh, okay. So like in your bookkeeping system, do you, could you record $1,000 every month in your computer system way back here in January? And basically you're, what would you call it? Like predating each transaction maybe? And you could do that. It's just that when you look at if you happen to look at a yearly income statement or P&L, it would include all of this that you see to the left there. But you're really only looking at it in March. So yes, you can. It's just going to depend on how you look at reports and so forth. I don't see any reason why you couldn't create 12 transactions going into the future. It's not the cleanest way of doing it, definitely not the cleanest way, but it can be done. I know I used to do it in my own business as an example. My partner hated it when he looked at our like at our bank register and such, because I had all these predicted, expenses recorded all the way down through, and it was just, I quit doing it, but that was the way my brain worked. Okay, my brain worked. I liked seeing all these expenses already in there, and so I would know like how much money am I going to have at the end of the year. So there can be reasons for doing it, but it's not the cleanest way for sure. Hopefully that answered your question, Kathy. If not, please put it back out there, or you can even speak if you have a microphone. Okay, so purchase of assets on account. Purchase of assets on account. I don't think we covered this one yet, did we? So we're going to purchase some assets. We're not paying cash for it right now. Will we record anything under cash-based accounting? I have heads shaken and I have people chatting. I appreciate that again. So there will be no transactions. Again, as a quick review, no cash was moved around, and cash-based accounting does not deal with fixed assets. What about under modified cash accounting? Under modified cash accounting, I have people shaking their heads and people typing. Yes, there will be. That's where we have the fixed asset and we have the accounts payable. It could be a line of credit. It could be a bank loan that's paying for this particular asset. Now, the reason I said like a line of credit, because I would not suggest that you use a line of credit to buy a $10,000 piece of equipment. That's where you need to use a commercial bank loan. But you might have an asset that has a short period, a short life on it. And that's where you would use accounts payable. So maybe like your inventory is where you would use accounts payables. And Kathy's asking, for clarification, does on account mean on credit? Yes, it's either on credit based on a loan, or it could even be that you go to maybe like a building contractor goes to a building supply store and buys lumber and other building supplies, and they run a monthly credit a statement at their location, and so that could be accounts payables as well. Under accrual-based accounting, you're going to have the same thing because modified is following the accrual-based. So we're going to have the accounts payable and the assets. And again, when we go to pay that accounts payable, we're going to debit it for a certain dollar amount, and we're going to credit cash. That's how we're going to decrease our accounts payable. Accounts payable is a liability on our balance sheet. So if it's a liability, that means it's something we have to pay, right? And if we're going to pay it, there's only one way to pay it, and that's either with cash, check, credit card, something like that. Okay, almost done with these examples here. And then don't forget, we do have a quiz at the end. Hopefully all of you got the document. And so we're going to take a look at it as well. So payments for assets purchased on account. Payment for assets purchased on account or on credit, right? So under cash-based accounting, Will we have a transaction here? Okay, so we are saying that we will have a transaction. We're going to debit the expense because it can't be an asset. Cash-based has no assets. And we're going to credit cash because cash moved. Good job. What about under modified cash-based accounting? Yep, there's going to be a transaction there as well, but it will be different. We're going to have accounts payable being debited, cash being credited. That was what I was showing you on the previous slide when I was writing on the screen there. And so under accrual based, we're going to have the same thing, accounts payable and cash. It seems like you're getting the hang of this. The people that are answering in the chat and the people that are shaking your heads, it seems like you're getting a hang of these transactions. So now let's look at a summary of cash-based accounting. Advantages and disadvantages. The advantages of cash-based accounting is that it's readily understood by people like ourselves, maybe, that have little accounting experience. It's cash in and it's cash out. So you don't really need a trained bookkeeper. Most people I think can do cash-based accounting, and you can do it on a notebook or a spreadsheet. You don't necessarily need a bookkeeping system. Some of you might use QuickBooks, and then there's other systems out there as well that you can use for bookkeeping. Not absolutely necessary if you're using cash-based accounting. However, there is this lack of error checking because we don't have both the left and the right, the T accounts. We don't have the balance sheets and the profit and losses that work with each other. So that can be a disadvantage of cash-based accounting. And then it only focuses on revenue and expenses. It doesn't focus on those fixed assets and those liabilities that you might have. Under accrual-based accounting, the advantages is that it's more accurate, it's more faithful. It's, recognize your expenses when your revenue is earned, recognize things together. It's a better picture of your financial performance, as I kind of already talked about with the cash-based. You have your income statement, you have your cash flow statement. It'll give you a better picture. And when you need to analyze your business, it is best to have all of the information. Let's say that when you go to buy a large piece of equipment valued at $75,000, maybe even only $10,000, your bank is going to want some financial statements from you. They're going to want definitely going to want the income statement, but they may also want that balance sheet. That's why I think a lot of you are going to go, if you're not accrual, you're going to go with modified cash basis. That way you can have a balance sheet and you can see those assets and those liabilities. That's what the bank's going to want to see. Under accrual-based accounting, though, you're almost definitely going to need a bookkeeping system. It would be really hard to keep track of all of your assets and liabilities and all of those monthly payments that you need to make, along with your revenue and your expenses, if you are trying to do it by hand or in a basic spreadsheet. There are more rules and regulations. I mean, even when you do a tax return, they're more complicated when you're doing accrual versus cash. So there's a few more rules and regulations there. And therefore, you probably need more accounting background. Now, my hopes is that through this training today, and if you come back next week on Wednesday, same time, same link, to learn about balance sheets and income statements and how to do some financial analysis, my hopes is that after these two here and attending other seminars, you'll have the accounting background to be able to do accrual accounting. Now, while I'm here, I also want to say that when we're using a computer system like QuickBooks, when we record our transactions in QuickBooks, if we do it properly, that's why you'll see SBDC's offering QuickBooks training, such as Penn West Clarion here. We offer a QuickBooks seminar. If you follow the directions properly to record those transactions, with a few clicks of a button, QuickBooks will spit out financial statements for you, spit out an income statement and a balance sheet, and it can show you it based on cash or accrual, whichever you want. You can click a button and it goes back and forth. So we're lucky that with technology, it makes our life easier. But have we ever recognized that because of technology, maybe we don't use our brain as much, and maybe we don't have as good of an understanding of what's going on as we used to have before all of the technology. So I'm not saying throw away technology. I love technology. But a class like this and like next week helps us understand what's going on in that bookkeeping system and what's going on in our business. We need to analyze our business so that we can plan for the future. The modified cash basis. The advantage is, I feel it's pretty simple to understand still. Once we get it into our heads that revenue and expenses follow cash, and the only time that we follow accrual is when we have assets involved that have a long life to them. Then it becomes easy to understand. Again, it gives you a better picture, kind of like the accrual-based accounting, because it is using and creating your financial statements, the balance sheet and the income statement. But it is probably going to require the bookkeeping software again because of the balance sheet. There are no rules governing, such as GAAP, that's governing modified cash basis. I will say, you kind of have the IRS and the Pennsylvania Department of Revenue that has their rules that we need to follow, and all of that trickles down into our bookkeeping as well. So you're not like completely erasing all rules. You still have a lot of rules there. And the modified cash basis, it would be helpful if you have some accounting background. Again, I don't think you need an accounting degree, although that is very helpful, but not necessary. So who's ready for a test? Yeah. Okay, so did you hopefully print off the worksheet that I emailed to you, or if you didn't print it, at least you have it available to you. So bring that up on your computer, or if you printed it out, let's bring that up. And I am going to get a document ready here as well. There we go. So the first example that we had is we're going to go through a day-by-day transaction, day-by-day occurrence of events, okay? And so we have an example on this worksheet where we performed services on account for $500. We performed services on account for $500. So I'm going to create a big T account, going to put debit on the left and credit on the right. So the question is, and you'll see it already on your paper there, is I'm asking you, what will we debit and what will we credit? Now, if there's anyone here that logged or signed up for this at like last minute, you won't have this worksheet with you, because I wanted to wait till closer. So I think I emailed it out to you maybe around 11 o'clock. Okay, in case we had people signing up late. So the question is what would we debit and what would we credit? And let me find where my chat went here. If somebody wants to try it in the chat in the future here, but what we're going to debit, as you see the answer for already, is we're going to debit accounts receivable and we're going to credit income or revenue, because we performed services on account for $500. We performed services on account for $500. Now, if we wanted to draw the individual T accounts, we could, okay? We would have accounts receivable for $500, and we would have the income or the revenue account over here for $500. So you can see how I combine the two T accounts into just one great big T account. Okay. How do I get rid of all this here quickly? So the next one you don't have the answer for, and this is where we're going to have to work through it. So on June 1st, if you go down on your worksheet, June 1st, Ray invested $50,000 in the business. So Ray invested $50,000 in the business. What will we debit what will we credit? Now, this is an example where you take an exam and the professor asks you this question that you never even went over at all in the entire class. And yet they put a question on here and expect you to know the answer for it, right? Because I don't think we covered this at all in today's lesson. So what will we debit and what will we credit? If you have the chat option, let's see if we can get an answer here. What would we debit? What would we credit if we invested $50,000 into the business? Okay, someone's saying 50K to credit. Okay, we see accounts payable and asset. We see owner's equity, debit cash, credit owner's equity. Okay. So let's see who's right. And you all should be able to see the chat, I do believe. So you can be looking at that as well. And so I do see a right answer here. We're going to debit cash. Cash is increased on the left-hand side of a T account. And so Ray invested 50,000 into the business. And then the credit for that is going to be owner's equity. Now, one of you could be kind of right here from what I'm seeing, but it depends on the word. So the example was Ray invested. In my mind, when I hear invested, that means I'm putting money into the business to help it grow, and it's going to stay there and it's going to be used. If I would have said Ray loaned the business $50,000, then instead of owner's equity, we would have a loan here. Maybe, whatever you want to call that, but we would have a loan on the right-hand side instead of the owner's equity. Great job. Okay, the next one, if we look down the sheet there on June 2nd, we paid for a 1-year insurance policy for $6,000. So insurance policy, come down, whoops, right there. Insurance policy for $6,000. Draw a big T account. What will be debited? What will be credited? So what will we debit if we paid for a 1-year insurance policy for $6,000? Okay, someone's saying we're going to debit cash. Cash gets increased on the left-hand side, but we paid it out. Someone else. So what we're going to see here, oh, and I forgot to tell you, but at the top up here, if you had a chance to look at it, at the top of the worksheet, it says, assume that this is the accrual basis of accounting. Okay, we're operating under accrual basis of accounting. So on the left-hand side, we're going to have a debit of a asset. It's going to be a prepaid asset called prepaid insurance. Prepaid insurance. And then we paid for a 1 year, so we actually paid it. So we're going to credit cash. So the 2 T accounts, if we want to do the 2 T accounts, we would have the prepaid insurance up here. Sorry, I write so messy. And it was 6,000, so it'd be on the left there and on the right there. It's just I've combined it right here. Okay, let's try the next one. June 3rd, we purchased medical equipment for cash. Again, we're operating under accrual-based accounting. So we purchased medical equipment. I think that's the key word there, equipment. Hold on, I'm trying to get this to work here. There we go. Equipment for $22,000.
and we paid cash. So if I draw a big T, debit on the left, credit on the right. Purchased equipment for cash. What will be our transaction? Put that in the chat there. Okay. Okay, so what we're going to have here, we have a few people putting out ideas, which is good. So if we're buying equipment, equipment is an asset, and an asset gets increased on the left-hand side. So since it gets increased on the left-hand side, we're going to put equipment over here. And because we paid cash, cash actually goes down when it is credited, when it's on the right-hand side of the T account. So on the left will be equipment, on the right will be the cash. Good job. Okay, we have two more here. So let me get this erased here. June 4th on your worksheet, we paid a bill for laboratory work for $300. So we paid a bill for $300. Accrual accounting. What will be debited? What will be credited? Put that in your chat. Okay, so I see, I'm going to go with this one for sure. We have credit on the right-hand side because we paid cash. We paid something out. So it goes on the right-hand side. What will we debit? For something for $300. Debit expense. Okay. What if I throw out the word bill? Because we paid a bill for laboratory work. So the bill is kind of the key word there. So expense, I guess if you went with like the question we had earlier, as in if we receive the bill today and we pay it today under accrual base, can we just make it one transaction, which we could. So we could call it expense. Now I'm starting to see it. I'm seeing accounts payable, or you might call it a liability, either one, because an accounts payable is a liability. So that is what would be debited. Accounts payable would be debited. Good job. That one made us think a little bit, and it's because we have to focus in on those specific words. Otherwise, we could take it a couple of different ways. Okay, one last example here in this quiz. You're doing good. So June 5th, we purchased office furniture on credit from Biddle's Furniture for $9,000. We purchased office furniture, which is an asset, right? On credit, that's another key word there, for $9,000. Big T account with our debit on the left, credit on the right. What will we end up debiting? And what will we end up crediting? And again, we could write it as two separate T's here. One T would be an asset. The other T will be a, I don't want to tell you that, I guess. Okay, our debits and our credits. I have couple people here. Credit accounts payable, debit furniture. Ding, 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 ding. There you go. So the asset will be furniture, and we'll debit it for $9,000. Over here would be asset. And our credit will be, they put accounts payable, so I'll call it, liability. Most likely, if you're buying furniture, and I guess it's for $9,000, so it's going to be more of a long-term liability, I'm assuming. So we'll call it liability. That'd be 9K, or over here you would put liability. Okay, good job. Okay, so that was our test. Now, if I made each of you answer that individually, then we'd be looking at each person's thoughts and questions on it to see what you came up with. But you did good. I appreciate you using the chat. This is the first time I've ever taught it this way, so I wasn't sure how exactly it was going to work. This is everything that I have for today. But if anyone has any questions, I am more than glad to answer your questions. I did finish up a bit early. I did this in 2 hours rather than 2.5 hours. So if you have any questions, you can unmute yourself. You can type it in the chat box. And then before you leave, you will receive an evaluation form that we would ask that you do please complete it so that we can improve this training and make it, hopefully make it better for next time. And then also, I hope you're registered for lesson level 2, which is next Wednesday. If you're not, please get registered for it as well. And we'll see you back here next Wednesday, same time, same place. Okay, so someone's asking, how do you calculate depreciation? So depreciation's not something that you can necessarily calculate on your own. There is the simplest type of depreciation is what we call straight line depreciation. Straight line depreciation is finding out what the life of the asset is, say, according to the IRS. So a building has a useful life of 39 years, a non-residential building, a commercial building has a useful life of 39 years. Rental property, like a rental house, has a useful life of 27.5 years. So what you would do is you would take the value of that asset and depreciate it by its useful life, say 39 years. And then that amount is what you would depreciate every year in your bookkeeping system or on your tax return. Now that's straight line depreciation. Most of the time on your tax return, you're not going to use straight line depreciation. You're going to use what we call makers, which is a modified type of depreciation. And a lot of times what happens is it depreciates more in the first several years and then less in the later years. So then your question is, okay, probably like, okay, well, if my accountant is calculating all these depreciations for my assets, how do I put it in my QuickBooks, or how do I put it in my bookkeeping system then? What you would want to do is after your taxes are done, you would want to ask your accountant for a depreciation schedule, and they can print off a depreciation schedule, which then has all of the data that you need to go into your QuickBooks and record what we call end of the year adjustments. And that was something in the PowerPoint that, let me see here if I can share it with you again so you can see it. Share. So if I get it to work here. If I go back to almost there. It'll say end of year, like right here, end of period adjustment example. So you're actually getting your tax return done in, say, March of this year, but you're going to go back and do an end of period adjustment as of December 31st, 2022. And you're going to record these journal entries in your bookkeeping system. Now, the journal entries, we did end up showing you that on the computer screen when we do the depreciation expense being debited and the accumulated depreciation being credited. That is the type of journal entry that you're going to record in your QuickBooks for every single asset that you have
on this depreciation schedule that you're going to get from your accountant. Okay, let me see here. Happy SBDC Day again to all of you. List of categories for modified. List of categories for modified. I'm not sure I understand what you're saying there, Kathy. In the PowerPoint, I know I had it on the slide, which you'll receive, that your revenue and your expenses follow cash-based accounting, except for assets. That'll follow accrual-based. So you'll have that, I believe. I'll also send you out a cheat sheet. That will, well, no, you're going to have the slide, I guess. That slide you'll have that told you assets are debited to be increased, liabilities are credited to be increased. You'll have that PowerPoint slide. So that'll be a nice little cheat sheet for you going into the future. Another person's asking a question, where can I learn more about T accounts? Do not understand what is a credit and what is a debit. Okay. And so one, that means I'll improve upon my training, hopefully, so I can try to give you that better understanding. So again, that cheat sheet though that I just got done mentioning, you're going to have that. And what I'll also do is I'll pull that, what I call a cheat sheet, out of the PowerPoint and make it a page all of its own, so that when you go to print that attachment, it just prints that one page, and that will tell you exactly, if you know it's an asset, it'll tell you whether it gets debited or credited to be increased. So I think that'll help out a lot for you, Bill. But if it doesn't, then please reach out to me as the instructor, or reach out to your local SBDC consultant, and they should be able to help you out as well. And then, okay, so Kathy's assets, accounts payables. Okay, so let me think here. So we're talking about the modified cash-based.
Yeah, what I'm asking is just, like every time we say, where are we reporting it? And you're saying it's a prepaid asset or it's long-term disability. Where are these categories that, that we're putting them under? How do we know which category?
Okay, so I think that's kind of the key right there at the end. How do we know which category? A lot of that comes from learning and from going through, this type of training to try to start to become accustomed to what it is that what type of account we choose. Kind of like when a young kid, learns their alphabet. They have no idea what the letter A means or how to even write it, but they learn that. And then from the rest of their life, once they learn it, they know that the letter A is the letter A and how it's pronounced and so forth. And so the same thing here. Are you using any kind of bookkeeping system like QuickBooks?
Quicken.
Quicken, okay, some people still use Quicken, and so I'm not sure if Quicken has a chart of accounts in there or not. It doesn't. Okay, so what I can do, I'll make a note here. I can find an example chart of accounts, and I can email that to everybody as well. And the chart of accounts, in my mind, what I'm going to look for is going to, I think, give you exactly what you're looking for. It'll be a list of names, if you want to say, okay, and it'll tell you what type of account it is. And I think that will help you recognize things that are assets and things that are liabilities, because it'll say it right beside it. So let me try that. Let me try sending everybody an example chart of accounts and see if that helps. If not, Kathy, please feel free to reach out to me. I believe you all have my email address now.
Thanks, Corey.
And okay, so someone's saying, more practice on the T accounts will help a lot. Good, yes. So that's something I would definitely take into account for next time, is let's work with more T accounts also.
Hey, Corey, it's Cindy. So we may be able to send out a few resources. I'm just checking online, and there's a few YouTube videos. There's a few books a few sheets that you can pull down. So we might be able to send out some follow-up resources for learning that. The other thing I wanted to go back to was that unearned revenue example. So just so that we can write it out as a T account. So remember so they asked about unearned revenue. So obviously you received cash. In your example, I think you used $50 or something. And then we debited cash because we received it. And then we credited the liability count of unearned revenue. And then to finish that transaction would basically be when you did complete the service, right? You would then debit the liability account of $50 and you would credit your revenue account.
Okay, there we go.
So I just wanted to make sure that we completed that visual.
Yes, and then we credited our actual income revenue account, right?
Correct.
Yeah, good. Thank you. I appreciate that. I haven't ran into this in a while. So this unearned revenue, it's actually a liability account because at one point or another, it has to be decreased. And so it gets decreased then when you actually are performing the service. And so that's why we have the revenue here of 50. That's the performing of the service. But now we're taking this down payment and we're moving it from a liability and we're erasing it, basically, is what we're doing. Thank you, Cindy. Appreciate
Correct.
that.
Yeah.
Okay, was there any other questions? Let me see here. General ledger account starting number indicates. Okay, so someone's saying here that the general ledger account starting number indicates if it is an expense, liability, and so forth. Yes, so this person here probably has an accounting background. So what you'll see in chart of accounts, I'll explain to all of you here, is that chart of accounts have numbers associated with them. Each account has a number associated with it. So assets normally start with a 1. It could be 101, or it could be 1001 or 10,001, but it the whatever numbering system you start with starts with a 1, and that's your assets. And then when you move down your chart of accounts, which I'm going to email to you, a list of chart of accounts, when you move down to your liabilities, they start with a 2. And then all of your liabilities will start with a 2, but the numbers after that can be different. So if you have 4 different loans, then you could have 201, 202, 203, 204. Okay. The words associated with those numbers for those liabilities could be, Ford loan, Northwest loan, seller loan. Okay, and those are associated with 201, 202, 203. You really have a lot of flexibility with the numbers that come after the 2. But what this person in the chat is saying about there being general ledger account numbers, the first number of whatever system you're using normally tells you what type of account you're using, what type of account you're looking at. So from a practical standpoint, accountants use account numbers. Nonprofits and government entities a lot of times use account numbers as well. Small businesses, not so much. I mean, they do if their accountant wants them to do it. But even when I teach QuickBooks, I explain these general ledger accounts because we see them in QuickBooks. And I explain that, small businesses don't necessarily need them. You don't need them for the IRS. You don't need them for Pennsylvania. You don't need them for audits by those government entities. So there's really no need for the account numbers for a small business. But accountants that grew up with learning that in high school and college, yeah, we live by those account numbers a lot of times. thank you for sharing that. That allowed me an opportunity to tell everybody about it. Any other thoughts or questions? You can unmute yourself. You can put it in chat, whatever you would like. Okay, well then I hope to see you all back here next week. I think that you'll really enjoy next week's training as well. Looking at the balance sheet and looking at the income statement. We're going to dive into them so we understand what's in each of those statements, and then we're going to look at how to do some analysis as well. So I think you'll really like it. It's going to take what we learned today to a whole different step, whole different level. Have a great day, everyone. We'll see you.
Thank you.